Thank you very much, everybody, for joining me this afternoon as I take you through an introduction to Helios Underwriting. My name is Martin Reith. I have been the Chief Executive now for only about 6 months, but my career has been in and around insurance for the last 40 years or so. So there are 3 key messages that I hope to leave you with today, and these are they. The market, the insurance market, the global insurance and reinsurance market is enjoying a period of significant market correction and discipline. That Helios offers an efficient, almost unique access to that market, and that we're now seeing the benefits of this hard market working through to reflect in the results that we're enjoying at Helios, leading to improved performance and an increased dividend strategy. Next slide, please. So a little bit about Helios. We invest capital behind Lloyd's syndicates. We provide them with what's called funds at Lloyd's, or FAL. So we are injecting capital into the very heart of Lloyd's syndicates. And over the years, we've built a portfolio by acquiring vehicles from names who are typically individuals that have supported underwriting at Lloyd's, names who wish to retire or exit the market. And Helios has managed to pick up and acquire a number of vehicles that gives us some really rather fabulous footholds in some rather well-established and outperforming syndicates. We are, in fact, the only public consolidator of private capital in the Lloyd's marketplace. Our portfolio is comprised of syndicates where we have ownership rights to participate and to share in their growth opportunities. These are called freehold syndicates. And we pay for this ownership, and this ownership has a value and is valued each year in the Lloyd's auction process, and it forms a significant part of our balance sheet. The rest of our portfolio is what we call relationship or tenancy syndicates, which is in effect where we have an agreement to support a syndicate for a particular year. Our support is generally, though, for longer than that, but we have no contractual right to maintain a position on that syndicate. And most importantly, the way we build our portfolio, our diversification, our capital management, and our curation means that we benefit from really exceptional capital efficiency. So the market, the insurance cycle is the best we've seen in a generation. I started a business in 2001 called Helios Underwriting, which was started in the wake of World Trade Center. That was an extraordinary time. This time it's different. This time it's better. This time it's more sustainable. And the point behind that is that what we're seeing today is not a knee-jerk reaction to a shock loss or a capital eroding event, but we're seeing judicious capital deployment where underwriters are absolutely hunting down the very best risks, the very best priced risks that they can see to build their portfolio. As a consequence, those of you that are investors already and those of you that follow Lloyd's will have seen that the first half year of 23, Lloyd's market reported some rather exceptional results, and I was delighted to say that Helios followed suit. So we reported a combined ratio of 88% and against a capacity of £310 million deployed in 23. And as we are seeing the better premium, the better loss ratio premium earned through, so we're able to increase our dividend profile. We doubled our base dividend to 6p, and we will look to make interim dividend payments where we possibly can going forward. Next slide, please. So, as I say, we're an AIM-listed spread vehicle offering investors what I consider to be unparalleled opportunity to provide capital to a balanced, curated, and volatility managed portfolio with a history of outperformance. And as part of that, we offer you an investment into a low or no correlated investment profile. We offer capital growth and dividend streams. There are IHT benefits associated to it with an AIM investment. We offer you a management team that is completely aligned with our investors, that is knowledgeable and experienced and able to use that to maximize the position for the company. And we offer you a strong balance sheet with an evolving business revenue model, which I'll come on to shortly. And we offer this at a time when the market has seen significant market correction, pricing adequacy and market discipline are the best for a generation. And our portfolio is at the leading edge of driving and shaping that market. Next slide, please. Here are a couple of pie charts that look to explain how our portfolio is built in 23. So we have £310 million of capacity deployed. On the left-hand side, you have capacity by syndicate, and on the right-hand side, it's by business line. We support approximately 30 syndicates at the moment. We go through a fairly rigorous evaluation process as to why we should support those syndicates. That includes a full drains-up approach or zero-rated approach at each year when we agree to support the syndicate for the following year. And then we have a continual performance and monitoring system in place whereby we measure performance against plan. So on the left-hand side, it highlights some of our larger positions. Our largest at the moment is Beazley Group, but we also include other household names that you'll be familiar with, such as Hiscox and Kiln and Atrium. And on the right-hand side, we've tried to drill it down by business line. And I accept that if you're not really in insurance, some of the descriptions are probably not very helpful to you, so I apologize. But let me just try and explain that our portfolio offers protection against casualty, marine, property, war and terrorism, cyber risk, professional lines, and what portfolio isn't complete without a healthy dose of personal lines. So we have some motor insurance in there. Significantly, we took a view at the end of 22 going into 23 to reduce the amount of natural catastrophe exposure within the portfolio. We just weren't convinced that the price was correct. And so you'll see at the bottom right-hand side that we are significantly down on that side as per that comment there. Next slide, please. Significantly, we have a track record of outperformance. The business has every year since 2014 outperformed the Lloyd's market on a return on capital basis by about 8%. At the end of that chart, as you can see, you might be raising your eyebrow quizzically at 2021 year of account. That's principally skewed because we have a rather unusual claim there with Russia and Ukraine. And typically our syndicates take a fairly cautious approach to reserving. And I would suspect they are slightly over-reserved, and I would expect that we would lead to an outperformance as reserves are released and the claims materialize. But as you can see, every year we have managed to outperform the marketplace, and we intend to continue to do that through our curation and portfolio management. Next slide, please. So I said at the beginning, these are favorable market conditions, and they really are. This is, in my career, the best we've ever seen it. It's perhaps slightly awkward that I think the real genesis of this hard market was driven by the regulator, who quite frankly said that enough is enough, and that the carriers had to haul themselves up to an appropriate level, but they all cantered there very happily and are now enjoying some extraordinary times where we're seeing continued market discipline, continued pricing robustness, and as importantly, we're seeing terms and conditions that are tight and controlled, and generally that's the first place that we see the market weaken. You have a comment from John Neal on the left-hand side. talking about how exciting the market is. And on the right-hand side, we have the Lloyd's risk-adjusted rate change, which, as every good graph should do, is up and to the right. And at the bottom, we have the Lloyd's combined ratio performance. For those of you that aren't familiar with combined ratio and GAAP accounting, in essence, anything beneath 100 is a profit. And so we're heading into territory in the first half year of 23. We're at 85% combined ratio, which is a very substantial profit. And I think every indication is that the second half year of 23 is looking increasingly and excitingly positive, as well, as we've had a low frequency of hurricanes. I've probably just ruined it there now, but let's hope I haven't. Next slide, please. So Helios, as I have explained, has a proven track record. We have acquired a number of limited liability vehicles, which has given us the preeminent position that we have in the market in terms of our portfolio and the access to the syndicates that we have. We also trade in the auction, so we might buy or we might sell to help us curate the portfolio. And wherever we have preemption rights across our portfolio, we tend to take those up, and that tends to be a very capital efficient way for us to grow our business. So on the left-hand side, you'll see how we have increased our capital over recent years. And on the right-hand side, you'll see how that capital has led to the deployment of capacity in the marketplace. As you look at 2023, we retain £245 million, part of the 310. The grey bar at the top is, the best way to describe it is our reinsurance. It's where we work with third-party reinsurers who provide us with some quota share protection and some stop loss protection. And we charge a fee for the quota share piece of that. But significantly, we have lent into this market and grown our retained position as the underwriting returns and underwriting discipline has continued to be attractive. Next slide, please. And we do all of this magic on a very low expense base. There are very few of us in the office, but I believe we have a very scalable operation. And I think that helps in terms of achieving economies of scale. I'm very confident that we can build our business quite substantially over the years to come and keep our operating costs of staff members at a really very low number. Our curated portfolio means that we work hard to minimize the capital requirements that support the portfolio. In rough numbers today, 45p invested with us gets you £1 of capacity. So it's a very, very efficient model. And as we look into the future, and I'll come on to that slide a little bit later on, in fact, it might be the next slide actually, we're increasing the use of what we're calling sidecar capacity, which is where I'm attempting to shift the quality of earnings of the company away from pure underwriting returns and more into a repeatable fees and commissions model, more of an EBIT style model. I think that will help for the share price, for the volatility, and hopefully we will start to be assessed as a hybrid company, earning both fees, commissions, as well as generating underwriting returns. Next slide, please. So as we look ahead now, I headed the slide with harvesting returns and positioning for growth, and I believe that's exactly what we're doing. We're actively building and curating our portfolio into 24. The market is exciting. This is a market, if there ever was a market, in which Helios has to increase its footprint, and so you can expect significant growth in our portfolio. Market conditions remain at or above our requirements. And as I explained briefly on the previous slide, our profits will be enhanced with fee income. And of course, for the first time in a long time, we're now seeing a return on our asset side of the business with interest rate environment as it is. So it's a perfect cocktail in many regards. We will continue to deliver better loss ratios better performance as the loss ratios earn through on the premium. Again, those of you not familiar with insurance, it takes time for premium to earn through, which is really the passage of a year. And so as the premium earns through, we would expect that to hit the bottom line. When I joined Helios, everybody spoke to me about Jam tomorrow. I think I can say that Jam is coming today now. The number of syndicates that we will be supporting will grow, so we are absolutely a spread vehicle. I'm hoping we'll go to about 40 syndicates next year. You can expect increased diversification, always volatility managed, and always at the most capital efficient way that we can manage. We're building on not just our own bedrock of syndicates, so the freehold syndicates that we have, but we're also looking to support new opportunities that we think adds diversification and a different flavor to the portfolio. The ownership that we have in the syndicates and the freehold syndicates, the value of those is rising, and that's very good for our balance sheet. And as we go out into the marketplace, we're actively looking for opportunities that bring business to London that doesn't normally gravitate to London. And what I mean by that is that if we can get access to certain bits of business that would typically be held in local markets, but we can support syndicates that bring it back to London, that's very diversifying for us. It doesn't aggregate with what we currently do. So it positions us incredibly well. And as I say, we're positioning the business away from pure underwriting and more into a hybrid type model. Also very important, we place considerable emphasis on building a portfolio with ESG credentials. That's very much part of our investment criteria when we sit down with syndicates and understand how they are dealing with ESG issues in their own businesses. Helios is a signatory to the UN Principles of Responsible Investing, and we are continually seeking out opportunities that are new to us that increase our diversification in that regard. And quite simply, there couldn't be a better time to invest and share in our journey. Next slide, please. So I'll just counter through these. We are a unique listed Lloyd's investment company. I believe there's one other on the blocks at the moment trying to start for 24, but we have an existing portfolio, we have a history, we have performance, we have access to syndicates, and I think we're incredibly well positioned. We have a strong track record of generating superior returns in the best market we've seen for a generation. We have unparalleled and perpetual access to some of the best performing syndicates at Lloyd's. Where that really shows in many respects is when the market gets tougher. The syndicates that form part of our portfolio have demonstrated that even in most challenging markets, they can generate an outperformance. When the market's as attractive as it is, I'm expecting all of our syndicates to deliver healthy profits. Profits are now being recognized from the larger portfolio. This is back to my point around the premium earning through at the better loss ratios. We are looking at every opportunity to return capital to shareholders, whether that be through share buybacks and or dividend streams. And I believe we offer a really compelling and highly efficient model with very substantial built-in capital leverage, giving access to this unique portfolio. So that concludes my presentation. I apologize if that was a little quick, but I'm clearly happy to take any questions anybody may have or expand on any points that you feel I may have rushed over. Thank you very much, Mark.
Thanks very much, Martin, for a most interesting presentation. We've got a couple of questions coming in from delegates, and there's a few more I'd like to ask myself as well, if there's time. Okay, so let's begin. So the first question from Robin was, how is tenancy capacity valued as against freehold capacity? Does it actually have a value?
No, tenancy capacity does not have a value because I have no contractual right to it. The way we try to engineer tenancy capacity is that it's not just for a year. We very clearly say that if we're going to go into this arrangement to support a syndicate, we would like at least to have a minimum time commitment to support them. And if we can, we'll try and secure preemption rights to grow with them as they grow. But there's no valuation per se on tenancy syndicate capacity.
Thank you. And then a question from Christopher, slightly broader one. Where do you see Helios in 5 years' time?
So great. I'm not sure I'm allowed to make forward-looking statements.
Nothing to do with the share price, but just in terms of where you see the business.
No, absolutely. I joke, of course. I mean, look, Helios is a sleeping giant in my view. It's done very well under my predecessor, Nigel Hanbury, and it's acquired some really rather fabulous positions in the marketplace. But its journey is just beginning, in my view. So clearly there's more syndicates we can support and more syndicates we can support to a greater extent. There's the possibility that we may even consider building our own syndicate and sitting alongside our portfolio in a follow line capacity. There's the whole point of disruption in the Lloyd's market today about lead follow. How do you access lead follow? In the tech world, it's alpha beta. So we're a consumer of beta at Helios. Other ways, more effective ways that we can get access to a flow of profitable beta that will allow Helios to grow. So all of those just within the horizon of Lloyd's is compelling in my view. But then why do we need to limit ourselves necessarily to the horizons of Lloyd's? There's a whole global insurance market out there that we can look to make strategic investments and capital support. That could be even taking equity positions in some MGAs that we back. So all I can really say, Mark, is that there's an awful lot to do. The journey's just beginning, and Helios is really very, very well positioned to maximize all of those opportunities. But there's a lot of growth ahead.
Very good. I'm sure the delegates on the call will be delighted to hear that. I don't know whether you're permitted to answer the next question, but we'll put it in to your discretion. So John was asking, how much did you buy in the current Lloyd's auctions?
So the prices in the auctions this year were high. Right. So I can tell you that we did not buy as much as we would like to because the pricing was beyond where we were prepared to pay. But we have filled some of the capacity that we wish to do that. I don't think I can necessarily put a number on it at this stage. I think the other thing to bear in mind from that, so whilst it might have been unsuccessful in delivering as much as we wanted to get out of the auctions, the fact that the prices were high means that the value that we have for our syndicates has increased commensurately. So the NAV of the company has increased quite substantially, and I think there's an announcement about that shortly.
Very good. Everyone will look forward to that. Can I just remind delegates, if you want to ask any further questions, just click the Q&A button at the bottom of your screens, and you can raise your question then. In the meantime, there are a few questions I would like to ask, because I don't have a lot of knowledge about the Lloyd's market, so they're quite basic questions. So the first question I had was, is there any limit to your liability in any given syndicate? And if not, how do you manage risk?
There is a limit to our liability. So
Ah.
Lloyd's shifted to a limited liability model. So it is no longer the old adage that you're down to your cufflinks, old chap, is no longer appropriate. So Helios is a limited liability entity, but we manage our exposure anyway, Mark, through a number of mechanisms that we have to make sure that we're not overexposed to any single event or catastrophe scenario. So it's we're well within our tolerances of risk appetite.
Thank you. That's helpful to understand. Then another fairly basic point. You mentioned that your capacity currently is, was it 310 million?
Correct.
Yeah. That's a lot higher than the book value of your balance sheet. How does the capacity relate to your book value?
So that's all to do with our economic capital model. So the fact that we have 310 million supported by a market cap of whatever it is, 120 million pounds, just showed you the efficiency of the model in terms of how our capital can be extrapolated to support that much capacity.
But how does that work? I don't understand that.
Well, that's a great question. So Lloyd's has a black box that looks at the syndicates that we have, but in essence, it's a mix between the business makeup that we have within the portfolio, the exposure to catastrophe, the exposure to personal lines, how we manage it in terms of reinsurance. And the cocktail of all that produces what's called an ECA, an economic capital allocation. And that drives the capital we need to support the capacity.
Okay, thank you. We've got a few more questions now from delegates. So Christopher has another question. How has Nigel Hanbury's role changed since your arrival?
Nigel is now Executive Deputy Chairman. He and I work closely together. Nigel has a wealth of knowledge, particularly around Lloyd's private capital, which frankly, until I arrived at Helios, was an area I had little exposure to, despite my many years in the industry. So Nigel works very closely with me as part of the executive team, but principally focusing on managing and helping us develop the private capital relationships that we have.
Thank you. Then Robert has a broad question. How are you regulated? Insurance companies generally fall under the PRA, but you're not exactly an insurance company as such. So what regulations, if any, are you subject?
We are not regulated. I mean, we're subject to AIM rules, but yeah. we are not regulated. But all the entities into which we invest are regulated.
Thank you. Yeah, that's clear. Okay. So Terence asks, if the market is at a generational high, why not use more leverage through excess of loss reinsurance rather than quota share, always assuming you can acquire syndicate capacity?
Well, that's a very good question from somebody that clearly knows what they're talking
yes.
about.
Knows more than I do. Yeah.
So it's a good question. So it's striking the balance really between how much we retain and expose to underwriting returns, and how much we seek to develop the hybrid model and earn fees. Mm-hmm. I'm not yet finalized in terms of how that split might happen. So in answer to your question, we continue to look at excess of loss, still very much on the radar, and it's likely we shall increase the amount of excess of loss. It's likely too that we shall increase the amount of retained in any event, because as you say, it's an exciting market, and why wouldn't you? But I'm also keen to start to bring in the fees and commissions angle slightly more to the business, and to start to position us more as a hybrid business. So I think in answer to your question, I'm trying to move all three of those dials forward as best I can. but we will certainly see an increase in retained and certainly see an increase in the amount of excess and loss.
Thank you. Yeah, I mean, presumably there's a balance to be struck between sort of short-term taking advantage of the market and moving to a more sustainable business with longer-term fee income. Is that how you see it?
There is, Mark, but the other aspect that I'm very mindful of is that, and this gets a little bit technical now, but under UK GAAP accounting, the way that the premium is earned in an environment where you're seeing substantial growth is not very helpful, frankly. So the better way to position the company, in my view, is to try and get to a steady state, to take the business to a certain level in terms of retained capacity, and then to earn fees and commissions. Because if we seek to grow as we have over the last 2 years at the same rate, the earnings drag on the premium is unhelpful, to be honest. So if this is the peak, or if 25 is the peak, I think the fact that we're thinking about growing the retained a little bit, but trying to share it with others is probably the right strategy.
Thank you. Then Robert asks, do you have a full-time risk director?
We do not have a full-time risk director. We have, funny enough, we're just about to talk about a risk committee at the board meeting that we have tomorrow. So it's certainly on the radar. We have we've just recruited an actuary, a pricing actuary, who's helping us curate the portfolio. We have a syndicate analyst. And we have a number of financial controllers within the business, but we don't have yet that person you describe.
Okay, fine. And then Christopher asks, what would be the worst loss the portfolio could suffer, and what would be the loss in percentage terms? Probably the latter aspect of the question makes more sense.
So we run a number of models to determine downside risk to the company, risk to capital. The worst scenario to us is a 14% loss on capacity, which is generated by a 1 in 30-year return period for worldwide aggregate exposure. So it's a natural catastrophe model at a 1 in 30 return period that would generate a 14% return per our models. But let me just add to that, 14% is really us simply adding up the returns from all of the syndicates that we participate. So I would regard 14% as being particularly cautious, actually. So that we've assumed no misfactor within our portfolio.
Very good. Well, that appears to pretty much wrap up the Q&A. So very much appreciate your presentation and for taking the time to answer all those questions. So thank you, Mark.
Thank you very much, everybody. Thank you, Mark.